So this week we're talking about the money supply process, and on Monday and Wednesday we went into the details of the open market operations and how the expansion and the contraction of the money supply works. And today I want to talk about a little bit more theoretical, just a little bit, and we will talk about a deposit multiplier, and then we will talk about um, the multipliers for the monetary base. So um, we said that the expansion of the money supply usually is through Fed's control. However, Fed does not have complete control over this, um, simply because there are four parties to the process, and it starts with Fed, and then you have the deposit institutions, and then you have the consumers or the retail, and then you have the borrowers, which also can be retail. So perhaps I should say depositors and then the borrowers. So when the Fed actually starts the process for the money supply, either expansion or contraction, um, the banks have a choice. Deposit institutions have a choice to keep excess reserve or just the bare required reserves. And based on that, the amount of the money supply process going forward is determined. So you have the deposit institutions will, playing a part into the money supply process. And then the depositors who may actually choose to keep cash or keep the money in the account and then just leave it at that. And then there the money supply process stops. So you also have the depositors will to either forward the process or stop the process at that point. And then the borrowers obviously can borrow or choose not to borrow or somewhere in between. And as you can see, the borrowers will also have the ability to stop or forward the process. So having said that, the intention is always to help the economic activity and to provide enough money for the economy to perform and to expand the monetary supply through the open market operations through the Federal Reserve banks. One of the things that they can do is to reduce the discount rate so that the deposit institutions can borrow more because it gets cheaper to borrow, and therefore that creates more borrowing, and therefore it creates money. And then we have the main focus of our discussion to buy securities through open market operations. And I'll go through that in a minute. It will be a little bit of a repetition of what we talked about on Wednesday. And through this, we talked about the analogy between having a pool with water and then you actually put paper in it and then you get water out or you drain the water out. So the idea is that more paper in the economy, less money. You're basically replacing money with the paper bond, the treasuries, and or vice versa. You actually take the paper out and then you leave money instead, and therefore you create a monetary expansion. And you could also lower the reserve requirement, so there will be more money for the deposit institutions to lend out. Now, to contract the money supply, we do exactly the opposite. And we can actually increase the discount rate, which simply means that it will be discouraging for deposit institutions to borrow more. We could sell securities or issue new securities, and through open market operations, that would actually replace or it will drain money out of the economy and leave paper instead. And we could increase the reserve requirements, which for every dollar of deposits the banks have, they actually need to set aside more reserves, and therefore it will actually leave more money for commercial banks to lend. So let's take a look at the buying the securities and how they actually affect the expansion of money supply. So we said that the central bank has assets and liabilities, and their assets are the securities that they own and the loans that they make to financial institutions within their jurisdiction or within their region. And the liabilities of the central bank include the currency in circulation and the reserves by deposit institutions. Um, because, yeah, I mean, the central banks don't have any other account holders. The only account holders at a central bank are the deposit institutions. So just like any other bank, deposits at central banks are its liabilities. So we started out with this is our starting point. So maybe I should actually just make that a little bit green. The idea is that we actually start with this. We buy the securities from Bank A, and then we leave reserves instead. And we started out with $1,000 reserve, but the Bank A chose to loan that money to a client customer. And when you loan it out, you basically just open a deposit account and put the money in there. And when the money is in that account, the bank has to set aside X amount of reserves. So for our example, we said that the reserve requirement was 10%. So we put 10% down, in which case the excess reserve becomes $900. So in a way, the bank A can actually create significantly more money. So then, this is where we said that when the borrowers or the depositors, if we choose to withdraw the money and put it in another bank, say the bank B, then the issue becomes whether that bank will be leaving, just the 10% of it to reserves or more. So will they leave any excess reserves or not? And then they will actually loan it out as well. And as they loan it out, the borrower or the depositors can actually choose to withdraw that money and put it in another bank. And that goes through the reserve. And then it just goes on and on and on and on. And therefore, at every point, we actually just lose about 10% of that original $1,000 that we bought out as Fed. And so with every bank that we go through, it's just a little bit less, a little bit less, a little bit less. And then we create a total of X amount of dollars. So we're going to calculate how we get that number today. So the idea, again, is that everything, the money expansion starts with Fed buying those securities. But obviously, like we discussed, there's the reduction of the discount rate and then the lower reserve requirement. So let me actually go through with the simple multiplier model, right? So, and one of our major assumption, obviously, is that we will have the commercial banks, so deposit institutions, not to hold any excess reserve. Now, remember, if the bank actually holds an excess reserve, then or chooses to hold the entire amount as an excess reserve, then whether Fed buys these securities or not is irrelevant because the deposit institution just keeps it as excess reserve, and the entire system just stops. So we will assume for our the simple sorry, for deposits, right? So we will go through as to, how did we come up with this number right here? And you can see I just typed it in. So how did I actually come up with that? And then we'll go through the money multiplier today, and then hopefully that will be it for today's discussion. So let's define certain terminologies. So deposits, let's refer it as a D. And then we have total reserves as R, and then required reserves are required reserves. So maybe I should just do this. And then we are going to have a reserve ratio, right? Required reserve ratio. And I don't want to do R. So let's do small r. And this also is very similar to the discussion provided by our textbook. And by the way, these deposits are, the M1 and M2, the checkable deposits, right? So they are available by upon demand. So And then the total reserves, right, will be equal to required reserves plus, or maybe I should also say excess reserves, right? Um, and so it's very simple. The total reserves is equal to required reserves plus the excess reserve. And the required reserves, by the way, so maybe we should just write that down. The required reserves are deposits times the required reserve ratio. Simple, right? So then what we can do is the total reserve is equal to deposits times the required reserve ratio plus the excess reserve. See, simple. So from this, we're going to have to take the deposits out because we're simply looking for a multiplier for deposits. But okay, so one of the things that we said that we were going to do was because if the deposit institutions choose to keep excess reserves, then the entire system slows down or stops. So we have an assumption that excess reserves are equal to zero. Right? So the deposit institutions will choose not to hold any excess reserve. So in this case, then this will become deposit. Well, I don't need a parentheses anymore. Deposits times the required reserve ratio, simply because the ER is zero, right? So then I need the deposits because we are trying to derive a multiplier for deposit. Then I'll take the R to the other side, which will actually make it so that the deposits are R over R, right? Or I could also do 1 over R times the R. Now remember, the small r is the required reserve ratio, and the big R is the total reserves. Um, and obviously, if I actually had any excess reserve, this have been like this, but we assume that the excess reserve is zero. So this is our deposit or the multiplier for the deposits. And obviously, if we actually choose um, to look at any changes in the deposits, then it will be the change in deposits that will be equal to the required reserve ratio times the change in R. So it will be the change, right? Delta D is equal to 1 over R times the delta R. Right? So any change in deposits will be, well, I think I feel a little bit better if I do total reserves divided by the required rate, required reserve ratio. So if total reserve, okay, so let's see if this actually worked. Let's go back to our spreadsheet. So we said that when the central bank through the open market operations bought $1,000 of securities from Bank A, they actually put $1,000 into the reserves. So if that is the case, then if required reserves, well, in this case, excess reserves is zero, so total reserves is increased by $1,000, and the required rate of and the required rate of return, required reserve ratio is 10%, then the deposit that it actually can create is this divided by that. That's about $10,000, right? So, and that's what we were actually doing here as well, right? So, and it simply is actually quite simple because it simply is dependent on how much reserves that you have to set aside. And then anything left over to you is your contribution to the economy, to the monetary supply. And therefore, every time you will actually reduce it about 10%, reduce it about 10%, reduce it about 10%. But you do this with enough many banks, it will actually create, the required, the total reserves divided by the required reserve ratio. And just keep in mind that the process is very simple, and therefore it actually has quite a bit of, shortcomings. Um, the main shortcomings, obviously, is when we hold cash or we hold money, then we basically have the process actually stops. So we also assume that the excess reserve is zero, which again probably may not be. And we also assume that the borrowers will borrow the entire amount. So there's always borrowers, which is also not true. I mean, like nowadays, Fed is increasing interest rates so much that the mortgage applications are plummeting. So, the system, the simple money model can actually fail or come short. So let's talk about a money multiplier, right? So what is it, and then how does it work, and then how do we actually drive it? So terminologies first, right? So let's start with a monetary base. Let's go down here. So remember, these are our, or maybe I should actually include it here. Monetary base, and let's call this MB. And we have, so the currency in, well, let's just say currency, but currency in circulation, that's your C. And then the total reserves is the R. So the monetary base then is equal to the currency and the reserves, right? That's, we talked about the monetary base, the M1 and the M2. So I'm actually going to need that to begin our money supply, a money multiplier discussion, right? So we need our monetary base. So let's start with that. Let's go to a new page. So we start with this. And remember, the monetary base is the currency in circulation and then the total reserves. So, and then I actually have a total reserve formula right here. And I'm going to keep the excess reserves for the time being, right? So what I can do is monetary base is then currency plus this right here. And because this is R, just going to remove that. And that's your monetary base. That's R times D plus D, or deposits times the required reserve ratio plus the excess reserves plus the currency in circulation, right? So now let's talk about a little bit more. So the money multiplier is actually a link, right? So, okay, let's go back again. Let's include right here, money multiplier, M. And while we're at this, let's include also the money, right? Money is the money in the economy, right? So the M. And now that we're talking about, again, this, M is equal to the currency and the deposits. I mean, that's the money in the economy, right? All the banknotes and the currency in circulation, plus the deposits that we have at deposit institutions. And again, I need these two because the money multiplier, where's my, yeah. So the money multiplier is the link between the money and the monetary base, right? So in fact, the money then is your money multiplier times the money base. So that's why we need the money multiplier, because as a central bank, that actually tells us the maximum amount of money that we can create with our interventionist policies, right? So then the money I'm just going to derive money multiplier from this is the money divided by the monetary base. And remember, monetary base is your currency plus the required reserves, or in this case, total reserves. And then the money is the currency circulation plus the deposits. But before we can derive the money multiplier, we actually need two more simple ratios. And I don't want to, right, so let's actually go right here and add it to our terminologies or the definitions. First, what I'm going to need is a currency ratio. And that's the currency ratio in the economy. So let's make this a small c. And in this case, the small c, let's have a definition right here, is the total currency divided by the deposits. How much of the deposits are actually in actual currency. And then the next one is the excess reserve ratio. And so all the same. And then, and I'm trying to be in line with our textbook notations, right? So the E would be the excess reserve divided by the deposits, right? So monetary base is currency plus the total reserves. Money in the economy, so perhaps I could have this at the top. Money in the economy is total currency plus the deposits. The currency ratio in the economy is your currency divided by the deposits. And the excess reserve ratio is the excess reserves of banks that are keeping at the Fed divided by the total deposits. And these are simple. The total reserves are the required reserves plus excess reserves. Required reserve is deposit times the required reserve ratio. And then any deposit, any change in the deposit has to be a change in the reserves times the required reserve ratio. So, oops. Ooh, sorry, I kind of lost the page there. So again, let's have the money at the top. Money is currency plus the deposits. Monetary base is currency plus the reserves, total reserves. And monetary base, then, we can actually substitute R, say the total reserves, as deposit times the required reserve ratio plus the excess reserves. We just assumed the excess reserve was 0. That's why we actually omitted it before. And then we now said that the money is a money multiplier, the link between the money multiplier, the link between money and the monetary base. So the money multiplier then is the money divided by the money base. So let's go ahead and continue with the derivation of the money multiplier. And what I'm going to do is I'm simply going to take these two, right about this, because this is where I'm going to start. So with the monetary base equal to C plus the deposit times the required reserve ratio plus the excess reserve. So what is C, right? Remember right here, we defined the small c, that's the currency ratio, C over D, which simply would mean then the C would be, the currency would be, then the currency ratio times deposits, and the excess reserve ratio, then excess reserve would be equal to excess reserve ratio times the deposits, right? So let's take these down. Just put it right here. I'm actually going to erase it in a minute, because all I'm trying to do now is to substitute these into my monetary base equation, right? For the CD or for the C, I'm actually going to do the currency ratio times deposits plus Deposits, well, you know what? I want to have the small letters first. Um, Required reserve ratio times the deposits. And then the excess reserve is excess reserve ratio times the deposits, right? I just simply substituted these into the monetary base equation. So now I don't need them anymore. So then what I can do is I could actually group them for the deposits. Then it will be deposits times C, that's the currency ratio, required reserve ratio, and the excess reserve ratio, right? So we'll continue from here. And again, remember what we're trying to derive is the money multiplier. So we are trying to derive this, right? So in this equation, one of the things that doesn't really, or what I need to eliminate is the D. So I don't want to have D. So let's move the D to the other side, which would make it so that we actually have the monetary base times 1 over C plus R plus E, right? So the deposits then are equal to the monetary base times 1 over currency ratio, required reserve ratio, and excess reserves ratio. So again, I still have the D, so I kind of need to get rid of it, right? So what do? Well, first of all, we know that the money is C plus D, right? So money, let me actually just write it right here very quickly. Money is, oops. Money is C plus D, right? And then we also know that the C is the currency ratio times the deposits. Then what I can do is I can actually take this and plug it right here. And then, see, I could actually group them again. So that would be D times 1 plus the currency ratio, right? So, which means I can actually have D equal to money divided by 1 plus the currency ratio. So then, going back to this, by the way, I can actually have D replaced by this. Very simple, right? And then I'm going to have the rest of this right here. See, very easy. Now, remember, by the way, the money multiplier is M over M. So money multiplier is money over monetary base. So what I need to do is I need to have this so that I can replace it as the money multiplier. So, and you can see how I can do that. I can actually move the 1 plus C over to the right-hand side and then move the monetary base to the left-hand side. So this equation, right, that's what I'm doing. It will be M over money over monetary base, which is actually, notice, the money multiplier, which is 1 plus the currency ratio divided by currency ratio plus reserve requirement, required reserve ratio plus the excess reserve ratio. So voila. And this now is our money multiplier, right? And so the currency ratio will determine, it will have a positive effect on the money multiplier. Reserve ratio will have a lowering effect. And the currency ratio, again, will have a negative effect. So the effect will be, I think, more obvious with an example, right? So let's go through with that. So an example is simple, that make it a little bit different though. If the required reserve ratio is say 5%, and the currency in circulation is say 100 billion, and then the deposits are say, I don't know, say 900 billion, and then let's decide that we want to keep excess reserves of say, I don't know, 50 billion, and all that let's say 5 billion. You know what? Let's make it 10 billion. And so how do we actually calculate the money multiplier, right? So first of all, we need the money, right? And that's your C plus the D deposits, right? So the currency is 100 plus 900, and that's a billion or 1,000. And then we need our, maybe we should just do that. So we need our so so let's have our formula right here. So then we can see what it is that we need, right? So we need the C, we need the R, and we need the E. We have the R, that's 5%. We need the C, and then we need the E. So what was the C? C is, let's go back, let's take a look. The C is, in fact, let's go all the way up. C is currency divided by deposits, right? So let's plug that in. The currency is 100 divided by deposits. So it is 1/9, right? 1/9. And then we need the E, that's the excess reserves divided by the deposits. So the excess reserve is 10 divided by 900. And that is 0.10 over 9, right? So then we can actually plug it all in. And in fact, then we have these as numbers, right? So 1/9 is 0.11. Sorry. So it is 0.11. And then we're going to do 10/90, 900, 0.0111, right? Now let's plug them all in. Money multiplier is 1 plus 0.11 divided by, so 0.11 plus 0.05, that's the required reserve ratio, and then plus the E, 0.011, right? So, and that would be what this is. 1 plus 0.11, that's your numerator. So 0.11 plus 0.00 plus 0.0111. And then the numerator divided by, and that's 6.49. And that's our money multiplier, right? That we derived. And this is our example, given that the currency is $100 billion Total deposits of $900 billion. Excess reserves of $10 billion. Required rate of return, required reserve ratio is 5%. So just to see what factors affect the multiplier, money multiplier in what way, what I want to do is I want to actually take this to the spreadsheet and then see if we can actually change any of the things as we progress. So this is R, this is C, this is D, and this is the ER. So the R was 5%, the C is 100, deposits are 900 billion, and excess reserves are 10. So the M is your currency in circulation plus the deposits. So that's 1,000. And then we need a C, well, small c, which is the currency divided by the deposits, the currency divided by the deposits. And then we need an E, sorry, which is the excess reserve divided by the deposits, right? And then you need to actually set this up. So the M then will be 1 plus C, sorry, 1 plus C divided by CRE, right? So C R E. And let's make this look a little bit better. So if the reserve requirement increases, say to 10%, and notice the money multiplier right down. If the reserve requirement goes to say 2%, notice how the money multiplier increases. So now you have a better understanding of how these individual factors affect the money multiplier. So when you look at the C, right, the currency ratio, if the amount of currency that we hold increases compared to the deposit. So all in all, we had the money equal to 1,000. So keeping that 1,000 the same, if I were to have more cash, but less deposits, notice how my money multiplier changed. In fact, I want to actually go back to 5%. That's 6.45. Now, let's keep more cash at hand as consumers, depositors, and less deposits. Notice how the money multiplier actually went down, right? So if we actually hold, say, 400 and then 600 as deposits, notice how the multiplier is actually incredibly lower now. So what else can affect this? The excess reserve, right? So let's go back to our original case of 900. And 645 is our base now for this example. And if you decide to have excess reserves, let's say 20, notice how, or say 50, now notice how the money multiplier is lower. And so the effect of the reserve requirement, currency holdings, and the excess reserves are all have an effect on the money multiplier. And it's imperative that you understand that the process of money expansion and money multiplier is not a maximized system in which the Fed cannot just make all the maximum effects happen. That while they can actually buy back the securities or sell the securities to contract or expand or contract, the important parties are obviously the deposit institutions through their excess reserve ratio or excess reserves, and then the deposit holders through our choice of keeping cash, and then through borrowing through the amount of deposits that we actually generate through loans. So again, thank you so much for working with me, and please let me know if you have any questions, and I hope to see you guys soon. And thank you. Really appreciate it. Have a great day. Bye now.